Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place. Welcome back to Intelligent Investor Insights. I'm Josh Barone, here with the guy who installed my economic operating system and still sends the patch notes, my dad, Dr. Bob Barone.
I just hope you're on the latest version. The early releases had bugs.
They were expensive bugs. All right, before we get to the $200 billion headline, let's lay the plumbing. In plain English, what are Fannie Mae and Freddie Mac, and why should anyone listening actually care?
Think of the pre-GSE world as a desert full of little wells. Every town bank had its own tiny pool of deposits. When that well ran dry, lending stopped. If your local economy hit a rough patch, good luck getting a 30-year fixed-rate mortgage.
Then along comes Fannie in 1938 and Freddie in 1970. The government basically says, let's stop relying on 1,000 shallow wells and build an aqueduct. They connect those local wells into one big engineered water system that moves money where it's needed.
Right. In practice, Fannie and Freddie buy mortgages from lenders across the country, bundle them, and turn them into bonds called agency mortgage-backed securities, agency MBS. They're like twin pumping stations in the middle of the housing system, moving capital from investors to borrowers and then back again.
And to go into those pools, your loan has to be conforming. That's just the gate code. Conforming means the loan meets FHFA standards, size limits that move with home prices, documentation, underwriting rules. Stay under the fence, you're conforming. Jump it, you're a jumbo, and you're funded in the private label wilderness.
So picture this. You make your mortgage payment. That cash flows into a giant pool with millions of other payments. Investors buy slices of that pool as MBS. Fannie and Freddie sit in the middle, taking mortgages from lenders, issuing MBS to investors, and passing the payments back through. Capital keeps recycling instead of getting stuck on one bank's balance sheet.
The key twist and why we like this asset class is the guarantee. On Fannie and Freddie MBS, the enterprises promise timely principal and interest. Ginnie Mae securities go a step further and carry the explicit full faith and credit of the U.S. government. Fannie and Freddie are technically different, but because of their history and conservatorship, investors still see them under a big federal umbrella.
And that's huge for pricing and resilience. If I believe a bond is very safe, I'll accept a lower yield. That lower required yield on Wall Street is exactly what shows up as a lower mortgage rate on Main Street. The guarantee is an invisible coupon boost for investors. Very high credit quality with an attractive spread over treasuries, and at the same time, a real affordability discount for borrowers.
Since 2008, Fannie and Freddie have lived inside this legal exoskeleton. Conservatorship under FHFA, capital rules, portfolio caps, stress tests, agreements with Treasury. I explain it to clients as, you almost broke the dam. So regulators reinforce the walls and set a strict waterline.
And they're doing that around a massive structure. The US MBS market is roughly $10 to $11 trillion. About 7.7 trillion of that is home mortgages inside securities. And around 6.5 trillion of those are 30-year fixed rate loans. Agency MBS is not a niche corner. It's one of the core load-bearing beams of global fixed income.
So if you zoom out, Fannie and Freddie are basically the circulatory system of U.S. housing finance. Millions of little mortgage capillaries all connected to this global investor heart, pumping capital in. Change what they can buy or guarantee, and you're effectively changing the blood pressure of the whole housing market. And for investors, the yield and liquidity profile of a huge, structurally supported bond sector.
And that's why when a president suddenly says, go buy 200 billion of mortgage bonds, people like us sit up straight because you're not tinkering at the margin. You're tilting flows in one of the safest, most important income generating markets in the world.
All right, let's go there. Early January 2026, President Trump goes on Truth Social and basically says, we're going to buy $200 billion of mortgage bonds and push mortgage rates down. That's the headline that hit everyone's feed.
And pretty quickly, FHFA Director Bill Pulte confirms that Fannie and Freddie will do the actual buying, agency MBS in the open market. The president points at the pipe and says, open that valve. And the GSEs are the hands on the valve.
Mechanically, this looks a lot like Federal Reserve style quantitative easing. You buy a bunch of agency MBS, that extra demand pushes prices up, yields down, and mortgage rates follow lower. Same basic lever, just pulled by Fannie and Freddie instead of the Fed.
But the plumbing behind that lever is different. The Fed has a central bank balance sheet. It can create reserves. Fannie and Freddie cannot. Their cash and cash equivalents are in the tens of billions, not hundreds. So when you hear 200 billion, the obvious questions are, how do you fund it? And how do you carry that risk under the existing caps?
Yeah, my inner banker read the headline and went, nice round number. Your balance sheet doesn't magically expand because you posted a thread. These guys are still rebuilding capital and conservatorship. Asking them to run a large, targeted purchase program sounds aggressive at first, but inside the exoskeleton we just talked about, it can be done in a pretty disciplined way.
Exactly. Before 2008, their retained portfolios grew too fast with too little capital. After the crisis, HERA and the Treasury agreements deliberately shrank those portfolios and put hard limits in place to protect taxpayers and the system. The 2026 directive leans the other way. Expand holdings somewhat to get short-term rate relief, but it still has to live inside that reinforced framework.
So this time around, those tools are operating inside that legal scaffolding. They can flex more in the short run, but they're still constrained by the same hard rules around capital, risk, and portfolio size.
Analysts immediately flagged the trade-off. Devote some earnings and balance sheet capacity to bond buying, and you slow the capital build a bit. You're trading near-term payment relief and somewhat stronger market liquidity for a slightly longer road to independence from Treasury. From our perspective, that's a mixed bag for the program itself. Helpful at the margin, but not a free lunch for the GSE's long-term health.
Yeah, and that's where we draw a distinction for clients. We like the agency MBS, have strong structural support, high credit quality, and deep liquidity. The directive doesn't change that. It just changes who's doing a bit more buying for a while. So we see the program as a modest technical positive layered on top of an already attractive asset class, not the core reason to own it.
I'd call the program tactically supportive, not transformational. Within the HERA framework, portfolio caps, stress tests, risk weighting, you can run this as disciplined, focused support for a period of time. But we're not counting on it as a permanent prop. The long-term story still lives and dies with fundamentals and Fed policy, not this one directive.
And the scale context matters. In an MBS ocean measured in the $10 trillion range, 200 billion is a powerful wave, not a new ocean. Big enough to matter for spreads and mortgage rates in the short run, small enough that it doesn't rewrite the playbook for Fannie and Freddie or for investors. Net, it gives agency paper a temporary technical assist on top of the structural reasons we already like owning it.
I'm still allergic to sloppy government-directed credit, and I wouldn't want this kind of program to become a habit. The reason we're comfortable here is that the underlying market is so strong and well-structured. If you already liked agency MBS for their credit quality and income, this directive is a modest near-term support, not the main pillar of the thesis.
Let's talk about what actually happened once this thing hit the tape. January felt like a crowded theater where someone yelled fire. Not panic, just everyone changing seats fast.
Right away, agency MBS spreads tightened. If you think a big, somewhat price-insensitive buyer is coming, you move ahead of it. That demand pushes MBS prices up and narrows the spread over treasuries. We saw that quickly. Spreads that had been out at stressed levels came back toward roughly 200 basis points over treasuries.
And you saw it in mortgage quotes. 30-year mortgage rates briefly dipped below 6%. If you're not in this every day, that might sound like just another number, but relative to where we've been, it lit up refi screens. A bunch of borrowers suddenly crossed the in the money line.
Lock desks got busy, pipelines built up. It also gave the market something it really wanted, a stronger bid under agency MBS. Liquidity improved, trading got smoother. A credible buyer of size tends to calm the water, and that's exactly what happened. Tighter spreads, better depth, more confidence in the tape.
From a client perspective, it felt like a window opening. If you were stuck at 6.5%, that dip toward 5 something gave you a shot at shaving real dollars off your monthly payment. That's groceries and gas money. For investors, it validated agency MBS as a go-to income sleeve. You had spread tightening plus rock solid credit, not some speculative beta trade.
But as always, gravity showed up. As investors digested the news, 3 things started to limit the effect. First, execution details. What's the pace? Which coupons? How do they stay inside the portfolio caps? Without clarity, the initial excitement naturally settles into something more measured.
Second, macro volatility never left. People were still reacting to inflation prints, growth worries, Fed messaging. As those forces ebbed and flowed, and as it became clear this wasn't open-ended Fed-style QE, spreads drifted back toward that roughly 200 basis point range instead of tightening forever.
And third, everyone understood this program is finite. It has to live within risk and capital constraints. As the buying pace slows, the extra support naturally tapers, and the broader interest rate environment reasserts itself. Long-term Treasury yields and Fed expectations still set the main stage for mortgage rates.
So if we zoom out, January looked like this. The directive created a powerful, constructive wave. Tighter agency spreads, sub 6% mortgages for a bit, a mini refi boom, and better liquidity in the MBS market. That's real, tangible benefit for households and a clear positive for investors holding agency paper.
But stack $200 billion against roughly $7.7 trillion in home mortgages inside MBS and 10 to 11 trillion of MBS overall, and you see the limit. It's a meaningful wave in a very large ocean. It can't permanently reset the mortgage rate regime, and it doesn't need to. You want market consistent pricing with solid technical support, and that's what this did.
So for borrowers, it was a helpful window. For investors, it was a tradable, income-friendly event. Spreads tightened, then normalized, but the episode reinforced a key message. Agency MBS are deep, resilient, and when policy leans in like this, you get genuine credit and liquidity tailwinds.
Exactly. Constructive, visible impact, clearly bounded by scale and by macro forces. As interventions go, it strengthened an already strong corner of the bond market without distorting it beyond recognition.
Let's pull this into what really matters for people listening: affordability and portfolios. I want to separate two things that always get mashed together: short-term rate relief and long-term housing affordability.
Those are not the same. You can knock mortgage rates down for a few months and still have housing that's fundamentally expensive because of supply. Zoning that restricts building, high construction costs, local bottlenecks, those are structural constraints. Spreads can tighten, but if there aren't enough homes, prices adjust.
Yeah, I tell clients this program is like giving people a smoother on-ramp to the existing highway. It doesn't rebuild the highway. On the demand side, the first group to benefit are refi borrowers who already own homes and suddenly cross that savings threshold. New buyers can benefit too, but they're still fighting elevated prices and, in a lot of markets, thin inventory.
Meanwhile, Fannie and Freddie have mission goals: support access to credit, including underserved and rural areas, manufactured housing, that sort of thing. FHFA keeps emphasizing equitable access, but always within capital and risk limits. The encouraging part is that this directive fits inside that balancing act and actually helps by keeping the core funding channel, agency MBS, strong, liquid, and cheap.
And because they sit in conservatorship with a very visible safety net, investors often treat their obligations as if there's an implicit government guarantee. That keeps funding costs low, which is good for borrowers. And it also means agency MBS trade like a structurally supported, high-quality income stream. The trade-off is they become irresistible policy levers when the economy gets bumpy.
So you end up with ongoing trade-offs. Programs like this provide useful tailwinds: lower rates at the margin, stronger bid for agency paper, better liquidity. They can modestly slow the GSEs' capital build and reinforce the idea they're policy tools first, businesses second. But in my view, at this size and within this framework, those are manageable costs for what you gain in market stability and credit quality.
All right, let me give some takeaways for investors. Number one, don't confuse a temporary spread compression with a new secular trend. The main driver for a gentle drift down in mortgage rates in 2025, 2026 is expected Fed easing, not any single GSE program. These directives are booster rockets, not new gravity, but they are real booster rockets for agency MBS holders.
Number two, if you're in MBS or broader bond portfolios, big GSE purchase programs are policy tailwinds, not automatic red flags. They tighten spreads, improve liquidity, and create tactical entry and exit points. You still map them against GSE capital, FHFA limits, and total market size. But here the signal is agency paper is being actively supported by both policy and structure.
Number three, if you own housing-related equities, lenders, REITs, home builders, recognize that these waves can briefly juice volumes or margins, especially on the refi side. They don't fix structural headwinds like supply shortages or local regulation. Those are multi-year problems, not multi-month ones. But a program like this smooths the ride and keeps the core funding markets healthy.
And number four, keep watching the longer-term GSE story: recapitalization, expansion of credit risk transfer, the path out of conservatorship. Every time they're used for short-term support, it nudges expectations about what normal looks like. So far, I'd say the system is absorbing those nudges just fine, and the fundamental attractiveness of agency MBS as a core income-generating allocation hasn't changed at all. In fact, it's been reinforced.
So I'd wrap it this way. Fannie and Freddie are still the steel girders behind the glass and marble of U.S. housing finance. This $200 billion directive didn't rebuild the structure, but it did reinforce it in a tough environment, lowering rates at the margin, strengthening the bid for agency MBS, and giving borrowers and bond investors a solid shove in the right direction.
And as always, economic gravity wins over time. The bond market and the business cycle are more powerful than any one press conference. But a well-designed program like this can make that gravity work a little more in your favor for a while. If you're positioned in high-quality agency MBS, you're on the right side of that.
All right, Dad, thanks for walking through the plumbing and not whacking my knuckles this time.
You passed today's quiz, barely. Thanks to all of you for listening.
We'll keep tracking how policy, markets, and housing affordability evolve from here. Until next time, stay disciplined, stay curious, and invest with intention. Bob, I'll see you on the next one.
Looking forward to it. Take care, everyone.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.